Good morning and welcome to T-Hub Capital, the Investors Lounge, the podcast where we explore financial market dynamics, emerging trends, and the insights that shape successful investments. Each week, we'll delve into the strategies and analyses that drive our investment decisions. You'll get an insider's perspective on the factors influencing markets and the potential winners and losers of tomorrow. Subscribe to the podcast to stay ahead of the curve and make informed investment choices. Enjoy listening.
Welcome to T-Hub Capital's The Investors Lounge weekly podcast. Today's date is the 20th of July. Let's dive into the week's top market news. Tech shocks, cooling inflation, and a new prime minister. A turbulent week for European markets. It was a classic tug of war across European financial markets, characterized by volatile swings, geopolitical anxieties, and a historic political transition in the UK. By the time the closing bells rang, the pan-European stocks Europe 600 index managed to scrape by almost exactly where it started, up a microscopic 0.07%. It was a flat finish to a rollercoaster ride, largely dragged down at the final hurdle on Friday as a tech sector sell-off originating in the US and Asia rippled into European trading rooms. Throw in a fresh wave of Middle East tensions, rising oil prices, and a heavy dose of corporate earnings, and investors certainly had their hands full. The market pain, however, was far from equal. Indices with heavier tech exposure felt the squeeze acutely. Germany's DAX slid by 0.94%, while Italy's FTSE/MIB suffered a steeper drop of 1.39%. France's CAC 40 managed to dodge the worst of the volatility, ending the week practically unchanged. Meanwhile, the UK's FTSE 100 emerged as the unexpected winner of the week, climbing 0.98%. Thanks to its relatively light reliance on technology names, London's blue chip index managed to insulate itself from the global tech rout. The Eurozone's economic balancing act. On the macroeconomic front, the Eurozone offered a mixed bag of relief and disappointment. The region's annual inflation rate was confirmed at 2.8% for June, down from the 3.2% registered in May. While this marks the lowest level since the onset of the Iran war, a welcome sign for households, it still sits uncomfortably above the European Central Bank's 2% target, meaning policymakers cannot afford to relax just yet. Even as inflation cools, the Eurozone's industrial engine appears to be sputtering. Instead of the growth that many analysts had predicted, industrial output across the bloc fell by 0.2% month-over-month in May. The downturn was primarily triggered by a slump in the production of intermediate and durable consumer goods. The industrial pain was highly localized, with Ireland suffering the sharpest decline, while economic heavyweights Germany and Spain offered a silver lining by maintaining their production growth. Zooming into specific nations, Germany's wholesale sector showed signs of cooling, though prices remained stubbornly high. Wholesale prices rose by 4.9% year-on-year in June, a decent deceleration from May's 5.9% jump. This inflation was heavily driven by expensive mineral oil products, chemical products, and various metals. Over in Ireland, the economic picture grew increasingly complicated. The Irish trade surplus narrowed significantly in May as exports plummeted by 29.1% compared to last year, heavily impacted by falling shipments of chemicals and pharmaceuticals. The domestic front showed further strain as the AIB Ireland Construction Purchasing Managers Index fell into contraction territory, dropping to 45.4 in June from May's 50.2, signaling widespread weakness in both residential and commercial building. Yet, despite these headwinds, the Irish housing market refused to cool down, with residential property prices holding steady at a robust annual growth rate of 6.2% in May. A new era begins in Downing Street. Finally, all eyes turn to the UK for a major political milestone. Andy Burnham officially took charge as the leader of the governing Labour Party, paving the way for him to officially step into Downing Street as Prime Minister. He inherits an economy that is showing tentative, if fragile, signs of resilience. May's GDP figures revealed a return to growth with a 0.1% month-on-month expansion, successfully reversing the previous month's minor contraction. However, the UK's industrial sector suffered a surprise setback, shrinking by 0.5% in May due to a slump in mining and quarrying output. This drop was notably worse than the modest 0.1% decline the market had braced for, reminding the incoming administration that the path to sustained economic growth remains a steep hill to climb. Now our insight into alternative markets, energy security and private equity, the new investment frontier in Europe. The past decade has severely tested the traditional paradigm of globalization. A succession of trade tensions, a global pandemic, and escalating conflicts at Europe's doorstep in Ukraine and across the Middle East have collectively exposed an uncomfortable truth, revealing that complex and interconnected energy supply chains are a point of strategic vulnerability rather than just an economic consideration. In response to this shifting geopolitical landscape, institutional investors and private equity funds are fundamentally reshaping their investment theses, with renewable energy emerging as the most credible and urgent answer to the widespread demand for regional energy independence. One of the most compelling aspects of this shift is the deliberate strategic choice to position renewables as private equity opportunities rather than pure infrastructure assets. This distinction is far from semantic and carries fundamental operational implications. Traditional infrastructure assets, such as highways, airports, and water networks, typically generate stable, predictable, and highly regulated cash flows that target long-term horizons with moderate but secure returns. By contrast, the current renewable energy landscape demands robust industrial execution capabilities, including construction, operational management, and technological optimization. It also requires the expertise for rapid scaling to seize favorable market windows, alongside the active management of technological and regulatory risks that are typical of the private equity realm. Ultimately, value is created through platform build-ups and active consolidation rather than passive asset management, allowing private equity funds to deploy their core strengths in deal structuring, active governance, and buy-and-build strategies within a sector historically relegated to lower-yielding infrastructure portfolios. A central tenet of this evolving market thesis is that decarbonization and energy security are no longer conflicting goals, but have entirely converged, reducing a nation's reliance on imported fossil fuels, which are often sourced from geopolitically unstable regions, automatically strengthens the strategic autonomy of a country or a regional bloc like the European Union. This paradigm creates a rare and powerful alignment between environmental, social, and governance sustainability objectives, national and European security interests, and the underlying financial return logic for investors. For a private equity investor operating with a global vision, this triple alignment significantly mitigates long-term regulatory risk, ensuring that European public policies like the Green Deal and Repower EU will continue to back the sector regardless of changing political cycles, because the stakes are now geopolitical rather than purely environmental. This dynamic makes Europe a uniquely mature market for solution providers, particularly companies that supply technologies and services for power grid resilience, such as energy storage, smart grids, and demand-side management. Europe represents the most advanced market in this space due to several structural drivers, including a legacy of regulatory fragmentation that has compelled utilities to seek highly flexible technological solutions. Additionally, the region benefits from a high density of industrial innovation across Germany, France, and the Nordic countries, combined with aggressive policy pressure on the energy transition front that outpaces the United States and Asia. The pressing demand to link historically isolated national markets further accelerates this maturity. For private equity firms, this translates into a richer and far more mature deal pipeline in Europe compared to other geographies, featuring target companies that have already moved past the risky startup phase and are ripe for growth capital or buyouts. A clear example of this trend is seen in strategies like those of Tikehau Capital, which focuses a significant portion of its capital on power grid efficiency, a critical theme that is often overshadowed by renewable generation itself. Investing in grid resilience involves financing advanced storage and grid balancing technologies, supporting the seamless integration of intermittent sources like wind and solar without compromising overall grid stability, and developing intelligent demand-side management platforms. This approach directly aligns with the thesis that true energy security depends not just on how much renewable power is generated, but on how efficiently that power can be distributed, stored, and utilized, since a wind farm without a grid capable of absorbing its output remains an underutilized asset. However, this transition faces a critical bottleneck, as renewables themselves remain dependent on global supply chains that are heavily concentrated in Asia for essential items like solar panels, wind turbine components, and rare earth elements for batteries. This dependence introduces a fascinating paradox for European private equity investors, who must navigate geographic concentration risks within critical components and perform deep due diligence to audit the supply chain resilience of target companies. At the same time, this vulnerability opens up lucrative localization opportunities, creating potential investments in the reshoring or nearshoring of critical component manufacturing. Consequently, investors must now integrate an extra layer of analysis into their models, recognizing that evaluating the renewable project itself is no longer enough without assessing the robustness of the upstream supply chain. The emerging landscape points to several clear strategic directions for private equity funds active in Europe. Firms should increasingly prioritize grid technology and storage platforms over pure generation, where competition is fiercer and profit margins are more compressed. They must also evaluate target companies based on their supply chain diversification to effectively mitigate geopolitical risks, while leveraging the maturity of the European market to identify buyout and build up opportunities before global capital intensifies competition. By embedding geopolitical awareness and energy security directly into traditional financial valuation models, European private equity has a unique opportunity to transform the energy transition from a regulatory burden into a lasting, structural competitive advantage.
Thank you for listening to this episode of T-Hub Capital, the Investors Lounge podcast. I hope you found this content interesting and inspiring. If you enjoyed this episode, don't forget to subscribe to the podcast so you don't miss a single episode, and share it with your friends and colleagues who might be interested. To learn more about T-Hub Capital and our activities, visit our website, thubcapital.com. You can also follow us on our LinkedIn page. See you soon. All the best from the T-Hub Capital team.